I am Jeremiah Ajuda Dusu, the author of JAD's Business and Financial Accounting. I am good to see you. It's been a while, and I do hope you had a very lovely holidays. Welcome back, I must say. So now, not to waste our time, we're trying something a little bit, but it's the same thing. We've been doing that if you must say the truth, but we're trying to, you know, bring in something a little bit, how do I put that? Okay, you just, let's see. Of course, you agree with me that in recent times, there have been, acquisition of businesses here and there. Of course, so long as visions, goals, and objectives of businesses are reviewed from time to time, of course, the growth objectives as well will be reviewed. In order to pursue that, business will definitely use either the organic or inorganic approach, to achieve the objective. So there are various circumstances in which you want to use an inorganic approach. Of course, in recent times, we've had existing businesses acquired by another existing business. For instance, I think Honeywell was acquired by Flour Mills. Yeah. Of course, also, but in the news that Union Bank was also acquired. So let's not begin to mention names, but then you must understand that businesses, when acquired, of course, let's say you have A Limited and then you have B Limited. Now, A Limited can decide to acquire B Limited. Of course, the operations can come in different forms. We've seen scenarios where A Limited acquires B Limited and then absorb B Limited into it. So that means that what? A Limited will continue to exist while B Limited will cease to exist. And that's sort of simple explanation. So it means that A Limited acquired B Limited, but then after the proper capturing of the transaction, A Limited we absorb what B Limited. So that means A Limited will continue to exist while B Limited will cease to exist. That's another scenario. I think we have a class of that on the Jarvis Consulting. And then we have another scenario where you have A Limited existing, you also have B Limited existing. That means A Limited will be existing, B Limited will be what? Existing. Even though A Limited acquired B Limited. So A Limited will be existing, B Limited will be what? Existing. But then, in this scenario, we normally refer to A Limited as a holding company. Why this is referred to as what? As a subsidiary. So what we're saying is that this is more like a parent. Okay? So this guy here, A Limited, acquired B Limited. Now we're looking at controlling interest. Of course, we have various aspects of the topic we're about to take right now. So it's going to be a gradual movement. We're not rushing, okay? So it's step by step. It's quite voluminous as well. So we take as much relevant aspect as we can. Okay? So here, A Limited is called holding company or parent company. But B Limited is called what? Subsidiary. So it means that what A Limited will be existing, B Limited also be existing. Even though we understand, that A Limited has acquired a controlling interest in what? B Limited. So in that scenario, where you have a parent company existing, and then you also have what they call it now, a subsidiary also existing. Okay, and then at a particular period, it is required that where you have, okay, the account for A Limited, you have the account for what? B Limited. It is required that we also know the position of the what? Business by what? Combining A Limited and B Limited into what? One what? Account. So basically, we call it group account. Okay, so we have it for balance sheet, also called statement of financial position, and then we also have it for what? The profit and loss, that's the comprehensive income. But now we're looking at the balance sheet. So here we're trying to what? Have an idea of what group balance sheet is about. It's quite voluminous. So we're taking it, step by step. Okay, we're not rushing. Okay, so in this very class, we're looking at let's call it outright control or acquisition, also called 100% what? Control. So it means that what? A Limited, which is called the what? Holding company or the parent company, has 100% what? Interest or control in what? B Limited. So that is what we're looking at today. Okay, and we are also, going to, focus in this class on, a scenario where the date of what? Acquisition coincides with what? The date of what? Of the group what? Balance sheet. So we also refer to this as consolidated balance sheet. Okay, so we can say date of what? Acquisition coincide what? Date of what? Consolidation. So what we're saying is that, okay, the date that it was given that that B Limited was acquired is the same thing with the date that we are preparing the consolidated balance sheet. Okay, so that is what we're looking at here, because it's also possible that the date that it is acquired is not the same thing as the date that we are consolidating. So in that case, we might be looking at what they call pre-acquisition values. Okay, and post acquisition values. Okay, especially in terms of reserve. Okay, but that is not what we're looking at today. Today's class, we're just concentrating on what do I call it now? On the scenario where the date that the business was acquired by the holding company is the same thing with the date that we're preparing the consolidated balance sheet. So, and then we're also looking at 100% control. Okay, that is what we're doing in this class. It's 100% control. That means the holding company has control, the entire control of the subsidiary, and then the date that the holding company acquired the subsidiary is the same thing as the date that we're preparing the consolidated balance sheet or the group balance sheet. Okay, so in that case, we can just simply look at what I am saying here. So let's say, of course, you should know your balance sheet at this point in time. You understand what your balance sheet is or what it looks like. Okay, so let's say A Limited, right? So this is A Limited balance sheet. Okay, of course we don't have assets, right? Let's just put the values here. So let's just say we have, of course, if you investment in B Limited, of course, if you're buying shares in a particular company, it's perspective. So as I was saying, it's perspective. Okay, so what I'm saying is, if A Limited, being the holding company, is investing in B Limited, okay, so of course you're paying crediting your bank and then debiting your investment. Okay, so that's like an asset from the holding company's perspective or the investor's perspective. Then it shares in the subsidiary company's perspective. So we say investment in, let's say 100, okay, and then we have other assets here. Let's say other assets, because that can be, your usual asset can be, any other asset you have. So let's say that is 200. So let's say total asset here is what? 300. And then that is financed by share capital of the holding company. Okay, so let's say share capital is let's say 200, and then we have what? The reserve of the holding company what? 100. So of course, you have your balance sheet of the 200. So if we say there is a subsidiary, let's put the subsidiary somewhere here. Let's put the subsidiary somewhere here. The subsidiary also have, so that's B Limited. Okay, so B Limited, that we have what? Assets of B Limited. Okay, so B Limited, let's say B Limited has its assets. Okay, other assets. Okay, let's say it is what do we call? Let's say let's call it 150. Okay, so assets for B Limited should be what? 150. Or you can add some other ones. So let's say 150 here. So we have share capital. Okay, for B Limited. Now let's say it is what? 100, and then reserve or profit and loss. So P and L, or you can use reserve. Okay, of course, your profit and loss. The bottom line, at the end of the day, your profit goes to where? The reserve of the balance sheet, right? I'm taking this approach. I believe at this level, you already understand what we've been, talking about from the onset. So you're just looking at an aspect where, of course, you already know how to report businesses separately. Now, looking at scenario where you have to now what, combine two different balance sheets to form one. That's what we call consolidated balance sheet. Okay, where a holding company is having interest in a particular company as a controlling interest. So it's usually required that to show the consolidated position. Okay, so let's say our reserve here. Okay, let's say it is what 50, right? So this here now will be what 150. Now as you can see, okay, that the A Limited balance sheet here, A Limited here is the holding company, B Limited is the subsidiary. Okay, this guy here is the holding company. This guy here is what? Subsidiary. Okay. Now we are now asked to what? Consolidate. As we want to show the position of the what? Balance sheet. If we combine these two balance sheets to one. Okay. Now you have to agree with me that this investment, okay, this investment that B Limited is A Limited is having in B Limited is to own what now? To own, are you there? To own the share capital and the reserve of what? Of B Limited. Of course, when you invest in that company, is shares you're buying. Okay, so the investment here is to own what? B Limited. Of course, shares in B Limited. So if you have the shares, you also have what? Control the what? Reserve. So of course, there are various approaches. Normal double entry can raise journals. Okay, so let's see what happens. Of course, this is an investment. I want to combine. This investment is in this company, covering what? Shares. So investment, don't forget your behavior for assets, right? What do you have here? Your assets have debit balances, right? Liabilities have credit balances, expenses have debit balances, income have credit balance. So your investment is a debit balance. So if you open an investment account here, so you have a balance what brought forward of how much? 100 naira. Now you're buying the share capital of B Limited, right? So if you look at B Limited share capital, this shares credit balance. So you have balance brought forward, right? How much is that? You have 100% control. We're looking at here. So we have what? 100. So now for you to buy this, that means you can close it and take it to investment account. We're trying to consolidate and bring them together. So you can take it to investment account 100. So this closes. So it's here now, right? So we have B's what? Share capital. Of course, if you own the share, you also own the reserve. So we have the reserve, right? Of course, it's also credit balance of how much? 50. Are you there? So in this case, you also take it to the investment account. 50 comes here to the what? 50. So this account closes, this account closes, right? Now, if you look at this investment account, I can see that you have 100 in the debit side, you have what? 150 in the credit side. So there's a difference. Okay, that difference is called either goodwill debit balance or goodwill credit balance. Of course, in recent times, not even what is common now is what we call the consolidated schedule. So we are going to have what they call positive goodwill or negative goodwill. Okay, so we'll get there, but let's understand this first. You see, now look at this. For you to agree this balance now, and that there's 15 naira difference here. So if you put your goodwill here, this will close out the investment to 150. So you now have what? Your goodwill account here. So this will come here, right? From investment, you have what? 50. So you can tell your goodwill here is having what? A credit balance. Your goodwill is having a credit balance, okay? So ordinarily, this it's like what? When you have a credit balance, that means it's either what? An income or a liability, right? Remember the behaviors. But here we're talking about balance sheet, so that means that it will be in the liability part. Okay, so but here when you have the credit balance goodwill, it is treated to, or it is usually recorded along with what? With the reserve, because it's behaving like what? A reserve. So with this now, if we want to now consolidate, okay, let's consolidate now. So it will mean that what? Look out now, it will not be what? How do we now call the balance sheet? It will be what? A limited and it's what? Subsidiary, right? Now, so let's just put it in another place. Let's say A limited and it's what? Subsidiary, okay? So now we have our what? Assets. What are the assets now? The asset now, this investment has cancelled out because of this. Okay, so we're taking only this. So we have other what? Assets. So what do you have here? This guy here is 200. So the 200 plus what's the asset we have for this guy here? 150. So our asset of what? 250. Okay? So what do we do? That means total asset is 350. So for this side now, what is your share? Share capital is what now? 200. So we have share capital. Okay? That will be what? 200. Now your reserve. Okay, which is supposed to be what? 100. So based on consolidation, now you're having a goodwill that is behaving as what? As a reserve. So it will form part of your what? Your reserve. So it will not be what? It will be 100 plus what? 50. So that's what? 100 what? You can see that balance sheet will be what? 350. Okay, so this is what? The consolidated what? Balance sheet. Now we have been able to combine A limited balance sheet with B limited balance sheet. Okay, so this is what we call consolidated balance sheet, A limited and it's what? Subsidiary. So you can see that because of this investment now, this share capital is no longer relevant. It is no longer what? Relevant. So we only took the assets, recognized what? The credit balance bill as a reserve. But assuming that we had investments higher than this, let's say what we had here is 300, or let's say 200. Okay, of course, this goodwill will not be here. It will not be a debit balance goodwill. So that means that we're going to have the goodwill added to what? Assets. Don't forget that when an item has a debit balance, it will not be behaving as an asset or what? As an expense. Because it has a credit balance, it's behaving as what? As an income or as a liability. So this is like using the what? The ledgers. In fact, some suggestions will use cost of control instead of this plenty ledger. They just open, we call it costs of what? Control. Of course, your investments here So debit balance, so you just put investment, the cost of investment to be how much? 100. Your share capital here, you put it 100. Reserve here, what? 50. So you now have what? Move it to what? 50. So you have 150, 150. Okay? So that means you still have your what? Credit balance what? Goodwill from what? Cost of what? Control to what? 50. That's what you're adding to what? Reserve here. Okay? So your credit balance goodwill, okay? The credit balance goodwill behave like a reserve. Why your debit balance goodwill as what? As an asset. That is using what? Ledgers. But now in practice, in fact, right now they don't use this, but you have to understand this. They use what they call consolidated schedule. So all these journals that we have raised will be represented in a what? In a vertical form or in a schedule. Okay? But because we are talking about what? 100% control, there is no minority interest. Minority interest is where the company is having less than 100% but is in control. Then maybe the company has 80%, then 20% is minority interest. Of course, that means when you have minority interest, then you have what they call major control, right? Majority what? Interest. Because majority interest is the holding company's control. Minority now is those other ones. So if you have, say, 80%, 20% is minority interest, then majority interest is what? We're not doing that now, we're doing 100%. That means the holding company has 100% interest in the subsidiary. So usually what you get now is what we call consolidated schedule. Okay, let's quickly take this very simple question. So we'll have an idea of what I'm talking about here. Remember, it's 100% ownership, 100% control, outright control, date of consolidation coincide with date of acquisition. So we have the following representing the balance of Kings Limited and Queens Limited as of 2018. So we have assets for Kings, Queen, non-appealing funds, blah, 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 like that. We have liabilities and then we have share capital. So they now said that King Limited acquired 100% shares in Queen Limited on 2018. The record will pay the what? Consolidated schedule and then consolidated of acquisition as at 2018. Okay, I already explained that it's a simple group, let's call it that. And then I told you that ordinarily you can use your journals, your debit, credit, open your ledgers, and then balance up and then prepare your balance sheet. But like I said, in practice, you have the use of what? Consolidated schedule. That's what they use now. So and then the schedule is like a representation of the journals you would have raised in what now? In your ledgers, representing it in a vertical form. Okay, so let's just see how this is. So we have what? Consolidated schedule. Okay, so this is cost of control, right? Let's call it cost of control. Of course, there's something called consolidated profit and loss. I don't think that is necessary here. Okay, but if it is, we use it, but if it's not, let's just put it there. Okay, so this is K in what? Q, that's 100% ownership or control. Okay, so here we have what? Queens, right? Share capital of what? 100,000. So it's 100%. So that means the K has full control. So everything here is 100,000. And what else? Of course, we have the shares, we have the reserve. So Queens again. What do you have? Reserve. How much is the reserve there? 21,150. 21,150. 100% of course, that would be 21,150. Okay? So we add up. We have 0, 5, 1, 1, 2, 1. So this is what we can say in terms of what? Ownership of the share capital and what? Reserve of points. So what is now the cost of what? Investment. How much? Okay, so how much has Kings invested in getting this what? Value of control. So if you go to the King's balance sheet, you have invested in we have 130,000. So we have 130,000. So when you look for the difference, what do you have? This is 0. Okay, 10 minus 5 is 5. 9 here, 9 minus 1 is 8. It's 8. So we have 8,850. But it is not represented like this based on the face here. What we are saying here is 120, 150 minus 120, right? So this has to be what? Like this. So this is goodwill. Okay? Now the question is, you're looking at it now, it looks negative by virtue of the bracket. But then you say, is it actually negative? You see, if on the other way around, this one here is higher than this one here, it will appear positive. But the question is it actually or positive? Okay, so there's this argument about positive goodwill, negative goodwill, and all that. But you see, of course, we can refer to the appropriate sections and then have some argument over interpretation. But let's not even look at that. Let's prepare our reports, okay, without causing any significant harm to the impression created for the users. Okay, so this is good. What do we do now? So what I would advise is that I will check. You can check this goodwill to know if it is what? If it is a debit balance goodwill or a credit balance goodwill. Because if you're able to use that understanding, okay, you will know where to place it. Is it going to be in the asset side, or are you going to transfer it to the consolidated P&L? Of course, like I said, if you have a debit balance goodwill, that's like an asset. If you have a credit balance goodwill, it's behaving like a reserve. Of course, your assets are debited, expenses debited, income credited, liabilities credited. So if you're going to represent a credit balance goodwill in the balance sheet, it will form part of what? The reserve. But in this case now, we have 850 in brackets. Okay, it's looking negative. This is actually negative. So let's just test. So we have what? This is investment. Investment from the perspective of the investor is an asset. So we have it in the debit side, following the rules of behavior of items. So we have 130,000 here. So of course it's against this, which is going to be on the credit side here. 121,150. So if you look at the difference here, the balance in the credit side here, that means your goodwill will come here to the 8,850, so that your investment account can close. And then you're going to have your goodwill account here, which is 8,850. You can see your goodwill is what? Is a debit balance goodwill, so it will appear on the asset side. It will appear on the asset side. So, of course, there is nothing we're transferring from the cost of control to the consolidated P&L, right? So we're not transferring. We can just bring our our holding company's reserves straight down. So what do we have now? We have Kings, right? Reserve. How much is there? 104.50. 104,500. So we have 104,500. Okay, of course, it's possible for you not to even put this here and then go straight to your balance sheet. So we have, let's prepare our balance sheet now. We've tested the goodwill to be the debit balance goodwill. So we say Kings Limited, and it's Subsidiary, right? So we have our assets. What are the assets here? Asset, land and building. So we have land and building. Of course, that's for both kings and queens, we have 80,000 plus 52. So what would that give to us now? 5 plus 80. If you put 2 here, that's 10. Then that will be what? 0, 0, 0, right? 2 plus 0 is 2. 5 plus 8, that's what? 13. 132,000. So what's the next one there? Furniture and fittings. So what do we have? Kings 40, 25, 500 for queens. 40,000. So what do you have? 0 plus 0 is 0. 0 plus 0 is what? 0. 5 plus 0 is 5. What do you have? 5 again plus 0 here is 5. So 2 plus 4, that's 65, 500. What next on? Debtors. Debtors here we have 20,000 plus 15,000. What do you have? 25,000. Cash at bank. Yes, in bank. What do we have there? 34,500 plus 28,650. So let's add 0 plus 0 here is 0. 5 plus 0 is 5. 6 plus 5, 11. 1. This will be 9. 9 plus 4, that's 13. 3, carry 1. So put it here. That will be 3. 3 plus 4, 7. 73, 150. You can check that if you want to. Let's check that here. $63,150. $63,150. Okay, so of course you don't need investment, but we have a debt balance goodwill here. So our goodwill is what? 8,850. So we add up. So what do we have there? So this is 0 plus 0 plus 0 plus 0 plus 0. That's 0. 5 plus 5 is 10. That's 0. Carry 1. 9. 10 again. 10 plus 5, 15. 9 and 5. Carry 1. This is 9 again. 9 plus 3. That's what? 12. Right? 12 plus 10. 22 plus 2, 24, right down 4, carry 2, 2 plus 6, 8, 8 plus 3, that's 11, 11 plus 6, that's 17, 17 plus 3, that's 20, so you write down 0, carry 2, so 2 plus 1 is what? 3, so we have 304, 500. Okay, so this is what? So what's the next one? What's the next one there? So we're going to say what now? Share capital. Or the share capital with that of what? Kings alone. Now it's 200,000. Now 200,000. Then what's the reserve from here? 104,500. Of course, we would have taken it from there because there's really no adjustment on that. So we add now 005, 403. So this is your what? total asset. This is your total. So what we've done here is to prepare, a consolidated balance sheet or group balance sheet, where there is 100% of outright ownership and the date of consolidation coincides with what the date of acquisition. Okay, so this is now standard. If you have questions, you can reach me on the number at display. I'm going to reply with the right answers. Thank you. Don't forget, you can support us by going to the account displayed or sponsor copies of my text. Volume 1, volume 2 and 3. Thank you.